All right, guys, this is going to be an awesome episode. We've got Travis here who's got a pretty interesting background and has jumped all in crypto. And you probably have some of the wildest ideas of what's going on in the market and kind of some of your strategies and stuff. So I think it's going to be fun. So thank you for coming.
Glad to be here. Appreciate it. Thanks for having me. I'm a little under the weather right now. Sorry for the hoarse voice, but we're going to be able to power through it here. So.
You're going to be just fine. All right. So let's go through background, right? Where'd you grow up? Kind of where'd you go to school, education, and then kind of what'd you do pre-crypto?
Yeah. Grew up in Texas, and growing up in Texas, I've been out of college for 10 years, and 9.5 of that was in energy investing, right? And so...
You really strayed really far from Texas.
Got out of undergrad in accounting, master's in finance, got out of school in 2008, took the financial crisis in the face, was doing oil and gas M&A for a couple years out of college in Houston, went to Magnetar Capital in 2011, doing long-short energy equities and non-controlled private equity and debt in the energy space. Pretty broad investment mandate, long investment horizon, highly illiquid or totally illiquid securities. I was there from 2011 through the middle of 15, so I was like the go-go years in oil and gas. So when I joined the energy business, I was managing $250 million. At Magnetar, when I left, we were managing $4.6 billion. So had pretty massive AUM growth over that period of time. Left in the middle of 15 and went to 0.72 in New York, Steve Cohen's hedge fund. And I was running a $200 million long short book there. Energy and materials, equities, a little bit of commodity, a little bit of options. And probably a good way to just easily segue into crypto here.
Why jump into crypto?
Yeah, so like I'm not a tech guy. I'm not a tech investor, and I'm not like a tech person. I'm not an early adopter kind of guy. I'm not like a futurist kind of guy. I've never been like that. So first time I heard about Bitcoin was when Silk Road got shut down, just from a fascination perspective. Like, look at these crazy drug dealers that made this magic internet money to go buy drugs on the internet. That's just wild. I joke around with my mom all the time where I'm like, Mom, it's a good thing that like I wasn't into drugs when I was a kid, so I like grew up to be like an upstanding citizen. But on the flip side, if I'd have been into drugs, I would have seen Bitcoin early and I would have bought that shit in 2012. But
it's true.
Same thing with video games. When I was growing up, I said the same thing with my mom too. I was like, Mom, I'm kind of glad you didn't let me play video games when I was a kid, which she didn't, because like now I read more than probably like 99% of millennials out there. But then on the flip side, it's like if you grow up playing video games and like somebody pays $100 for a magic battle axe, and then you see Bitcoin come along, and you're like, this makes all the sense in the world, right? So,
absolutely.
But anyways, yeah. So I was reading about Silk Road just because it's crazy. Bitcoin is part of the story. I probably read like 2 hours worth of about Bitcoin, and my takeaway from that was magic internet money. There's a math problem. The math problem is really, really hard. It controls the supply demand, and drug dealers trust it to use it as money. I'm like, that's just nuts, right? So then Mt. Gox got hacked like not long after, and to me that was like, okay, this is like not something I need to pay attention to.
Yep.
Because like I don't have any way to mitigate or price in the risk. I wake up one morning and somebody stole all my stuff.
It's like 2 strikes.
Yeah, and like being the like non sort of like hardcore computer guy, I'm like, if anybody's gonna get their stuff stolen, it's probably me, right? So like I'm not into this. Didn't think anything of it. Fast forward to the back part of 2016, price starts doing its thing. I started reading more about it. Early 17, Ethereum and the ICO started going crazy. I started reading more about it. And I basically came back like from July 4th break last summer and fell down the proverbial rabbit hole and just like started spending all my time reading about crypto. Go to the gym, listen to crypto podcasts, go home, sit on the couch in the dark, read about crypto to the wee hours of the morning, wake up, do it all over again the next day. And like, I started stacking up, like, you're doing this self-study, and like, I really liked behavioral economics and like game theory stuff when I was in grad school. And in grad school, like I had a graduate degree in finance, and like they hammer like efficient market hypothesis, like when you're in school, and then they like do a little bit on behavioral economics. And that made no sense to me because it was like so obvious that like the world's not, like markets aren't efficient at all. And behavioral economics is like really what makes sense because people, because of fear and greed in the context of like economic decisions, humans constantly make mistakes, right?
Yep.
And behavioral economics is kind of the study of that. And so I did like a lot of self-study in school about that. So then I circled back to crypto, and it, it loops in a lot of those aspects. And so I really got sucked into it. I did probably 400 or 500 hours over a couple month period of time. And I went to senior management out of the blue at the end of September. And I was like, look, this blockchain thing is going to be completely revolutionary. It's a once in a generation type of deal. And I don't want to be an equity long short portfolio manager anymore. I'm going to make a career change.
That's awesome. All right, so let's back up. You came from what I'll call like Wall Street institutions, right? So whether it was energy trading kind of pre point 72 and then point 72, what is that like, right? So when you're inside of these organizations, how do they view technology? How do they view kind of these new asset classes when they kind of pop up and some of them stay, some of them don't? Just kind of talk about, being a, kind of more traditional institution looking out at, technology and new asset classes.
Yeah, so I was kind of buried down in the, I was just doing my oil and gas thing, my energy thing. I did a decent amount of renewables as well too. So I was like kind of focused in that one lane.
So you're pretty much not looking at anything outside of oil and gas.
Energy broadly. Energy broadly was like basically my career. And like, I was like 30 years old and knew about as much about oil and gas as like any 30-year-old you're going to find, right? Like that was just kind of what I did. But working in institutions like that, I think one of the biggest differences that I think I've definitely taken with me, as I've moved into crypto investing full time is I think people that haven't worked at a hedge fund before think that it's like an episode of Billions or it's like Wolf of Wall Street or it's like Boiler Room or something like that. And it's actually way less sexy than that. Mm-hmm. And it's very, very process oriented.
Yep.
And especially at point 72, they just like you become an expert in how to build investment frameworks.
Yep. It's a machine.
Yeah, it's a machine. And like in the same way that Henry Ford used to crank out Model Ts, like you can crank out attractive risk-adjusted returns on a repeatable basis like that. And simplistically, like the way I think about it is you build this framework and then you put a bunch of processes inside of the framework and then you put a bunch of tools, you build a bunch of tools inside of the processes to help you execute those. And in the same way that Henry Ford used to crank out Model Ts, like you can just crank alpha like that. And it's like making sausage. Yep. You take a shitload of data, you stick it in the sausage maker, you turn the gears and it spits out profits. And you just do it over and over and over again. And there's...
That's not, but that, just so we're clear, right? Like that's not what people think is happening, what you just said. And then two is, that doesn't sound very fun, right? Because it's not human driven in terms of I'm making a gut call left or right. It's much more, we spend a bunch of time building what data sets we're going to do, clean it, structure it, build the machine, start stuffing the data through. There's not a lot of dependence on the individual to have intuition or make mistakes or make kind of the grand slam call, right?
Yeah. So generally speaking, like humans are like pretty terrible at investing.
Absolutely, absolutely.
Right, and we have so many biases. And we make tons of mistakes.
We get tired.
And yeah, right. And so like the term quantum mental got thrown around a lot at point 72, which we've like totally adopted into Ikigai Asset Management's, like it's at the core of how we've built our investment business.
Mm-hmm. Explain what that is.
Yeah, so it's just the intersection of fundamental and quantitative investing, or like said differently, like harnessing the power of big data to help humans make investment decisions.
Yep.
And like simplistically, it's like you ask yourself the question, like, what exactly is it that a human does better than a machine when it comes to investing? And like the punchline is, it's like not all that much.
Yep.
And like this war has been waging for over a decade now in traditional asset classes.
Absolutely.
And like the war's over, dude. Like the machines have like fundamentally beat the humans when it comes to like traditional asset class investing. Just look at the profitability of a place like Renaissance or Jump Trading or D.E. Shaw, right? And
it's because the machines are not only quote unquote smarter, but they have the ability to do much more analysis more consistently over a long period of time.
Never get tired.
Yep.
Never, don't make no biases.
Yep.
Can crunch an incredible amount of data. Then you start layering in like, machine learning type of stuff and this, that, and the other. But the interesting thing about that, the quantum mental aspect as you move into crypto is a machine is only as good as the data that you're feeding it, right? Like the data is like the food for the machine. And if the investment decisions that the asset class is presenting are not like quantable, like they're not able to be sort of fed into a data stream format, then a machine's not gonna be able to make very good calls.
Yep.
And like in my opinion, where we are in crypto assets, we're not far enough along, and the most foundational pieces of this ecosystem haven't been put in place yet. And so because of that, machines like don't do that well in that kind of environment, and the data has a lot of noise in it, right? And like if I'm trying to run like a stat arb strategy and like a crypto stat arb strategy in like September 2018, and I'm like, it's a strategy that was back tested against price action in like the fall of 2017. But like, what the hell does the fall of 2017 have to do with September 2018, right? This is such a drastically different market because we're so early in we're still having these big seismic shifts in the way the market's acting, but.
I think what you're talking about here is there's two issues. One is the quality of the data or the reliability of the data, right? So there's just not that many market cycles to look at. There's not that many kind of great data sources that you have a high level of confidence in. And then the second thing is there's also a lot of investment opportunities that there's no data. So early stage investing is really, really hard to quantify. Correct. Right?
And the way that humans do early stage investing is like, so like I can't have a view on Ethereum without having a view on EOS. And I can't really have a view on either two of those things without having a view on Hashgraph.
Yep.
And when you think about that spectrum of investing, a machine's like not that great at like humans are really good about taking this really broad set of data and kind of like taking this unrelated thing over here and being like, this kind of helps me think about how this is going to be, and like this other thing over here that's got nothing to do with crypto at all. Kind of like, it's like, oh, I read about the history of the internet and like it helps inform my decisions about how I think some of this is going to play out. Like machines don't do that well, right?
Multi-dimension like thought process and decision making.
Right. Yeah. And so the way that we've built it at Ikigai now, we've got one systematic strategy. We've got algorithmic market making that's run by a piece of technology, and everything else is a human at the end of the line pulling the trigger. But you're pulling the trigger, you're making investment decisions informed by information that like quantitative type of data and things that look more like quant strategies that help inform the investment decisions that the human makes.
Absolutely. So let's go back real quick before we jump full into crypto here. Let's talk about 0.72, right? Obviously, you can only say so much about it, but walk us through like what makes that place special and what makes that place different from the repeatability of the returns they're able to drive for decades.
Yeah. Culture of excellence, incredibly high caliber people from top to bottom. A stunningly strong operational framework, so that as an investment professional, like the operations of a hedge fund or the foundation that you're standing on, right? Mm-hmm. And you're trying to build a house on top of that foundation. And like the foundation at 0.72 is like the most rock solid slab you could possibly imagine, right? Mm-hmm. I mean, I think there's like 1,000 employees at that firm, right? And, I don't know what the ratio of like back office to front office is, but it's like 2 to 1, 3 to 1, something like that, right? So you're standing on this rock solid foundation. You've got every resource imaginable at your fingertips, and it kind of feels like you're playing pro ball. Mm-hmm. It helps you kind of elevate your game, and it's a great culture and a great environment. So
because the person next to you or down the hallway is not only world class, but they're here to eat your lunch. Right.
Yeah. I mean, it's not, I feel like people sometimes think it was not like this, like, it wasn't like cutthroat. It wasn't like nobody's trying to like stab somebody else. It was not like that at all. So I can't speak to like old SAC, right? Like early 2000s SAC, you hear stories about that, but I joined in the middle of 15. A fantastic place to work.
Loved it. Yeah. That's awesome. Yeah. It's great too when you can leave a place like that, not only say, hey, I learned a bunch, I worked with great people, had great culture, and couldn't speak more highly of it.
Yeah.
Right. So that's awesome. All right. So what was the reaction from, either people at 0.72 or just Wall Street in general when you say, hey, long short equity, that's great, I'm taking the full jump going into crypto? Are people excited for you? Are people think you're nuts? Are they trying to follow you down the rabbit hole? What's going on there?
I'm sure probably not to my face. I'm sure many people thought I was completely insane. My mom thought I was crazy, right?
Moms always think that you're nuts until you prove that you're right. And then
you're going to do what? What is this?
They believed in you the whole time.
All I read about is it's for drug dealers. Right? I'm like, that's not true, but you got to look out in the future. My mom's like a small town Texas mom. Grew up in College Station, Texas. My mom grew up in College Station, Texas.
Yep.
My mom still lives in College Station, Texas. So like, No, but generally speaking, I think people probably thought it was early.
Yep.
I didn't think it was that much of a risk it didn't feel risky to me. It was there. So like, again, not a tech investor, not a seed stage investor. That wasn't my career path. And the only other time that I felt like I did when I really dove into crypto and started understanding it was the first time I took an Uber. In Chicago, when I was living in Chicago got Uber super early. It was the second city after San Fran to get Uber. So I think the first time I took an Uber was like, January 2011 or 2012, something like 18 months after they started or something. Nobody had ever heard of it. I don't remember how I heard of it. Downloaded the app. Black car comes and picks me up from my apartment. I go to a store, drops me off at the store. I'm standing on the sidewalk, drives away. I'll never forget it. And I remember I was like, that is going to change everything. And I was positive about it. Mm-hmm. And sure enough, like, you watch what Uber did, obviously, over the coming years. And I used to joke around, like, the day I took that Uber, I should have just quit Magnetar and walked into Uber's office and been like, I'll push Microsoft Excel for you. Like, I'll do biz dev, whatever. Just pay me in stock, right? Would have been a good career move.
Beyonce's got a line, pay me in equity.
Yeah,
right?
Yeah, exactly, right? And I would have been probably the 25th dude at, whatever, at Uber, and like that would have been a nice move. Only other time in my life I felt like that was when I really understood crypto and I dug into it, and I just didn't have any doubt in my mind that this thing was going to completely change everything. Mm-hmm. And specifically, I'm super unsure about how that's going to happen. It's just I'm directionally, broadly, highly convicted, as bullish as you can be. And I was like, it felt like just like a great bet to go make in terms of like betting my career on it.
Yeah. It's this idea of confident in the trend, details to be determined.
Yeah.
Right.
Yeah. So it's like what I tell people is like, there's a non-zero chance that Bitcoin could be Netscape and Ethereum could be Alta Vista. And we haven't seen Google, and we haven't seen Facebook, Amazon, Netflix, Uber yet. And there's a non-zero chance that Bitcoin could go be the global, immutable, decentralized store of value in the world reserve currency. And one BTC could be worth 450K or 2 million or 3 million or pick a number, and everything in between.
Yep.
And I'm really not sure about specifically how that's going to play out. And so everything the way we've built Ikigai is to have malleability in our mandate and to have a clear look into how this thing is going to play out so that you can make investment decisions accordingly. And it's like you just go with the strong opinions weakly held thing, right?
Yep.
You intake as much information as possible. You assess that information, you analyze it, you make investment decisions based on it. And when something new comes along, you change your mind, dude. You change your mind.
How do you do that, though, right? So you've got conviction on something, you got the strong opinion, right? You know that it's loosely held, but what are the things that you look at that would change your mind, right? Is it data? Is it conversations? Is it gut? Like, what are you looking at that allows you to change your mind, not necessarily on a dime, but pretty quickly to go after a different opportunity?
It's a great question. It's so many things. Yeah, it's so many things. I mean, coming from the world that I came from, I do latch on to any kind of data that I can. It's pretty natural to me. Probably done more work in that than certainly not everybody. Like hats off to like a Nick Carter, right? Like the guy's a beast with all that stuff. And Brendan Bernstein's great. A lot of those guys. But I definitely have a tendency to just take that, like anything I can quantify, let me try and quantify it. And maybe I can't draw an investment decision from it, but let me at least have it. Give me as many tools in my tool shed as I can get, right? And then this space is very big on narrative investing, right? So you kind of track these narratives and start thinking through that, and you have to understand how these things are developing. Like a year ago, we were talking about Bitcoin, like we're going to use Bitcoin to buy a cup of coffee. Remember that?
Oh yeah,
that was a year ago, right? Oh, that's what we're going to use Bitcoin for. Okay, got it. And then you just like as people realized that wasn't going to happen anytime soon, it's like, oh no, it's digital gold. It's digital gold, right? Oh no, Austrian economics. Remember Austrian? Yeah. And I get it, right? And I get that. And then it's like, Ethereum, world's computer, right? Oh, it's a decentralized computer, blah blah, this and the other. Oh, it doesn't scale. Oh shit.
What else can we use it for?
Oh yeah, but it's going to scale because we got Casper coming. Oh wait, we don't. Casper's not close.
No, we can save the world's electricity because we're going to go proof of stake.
Right. But even from the very beginning, like when I really went down the rabbit hole, just because I am a really cautious guy, like like as a investor and as a human, I'm cautious. Like I would never go skydiving or like I'm not about that life whatsoever. And as an investor, I'm very like cautious in the way that I invest as well too. And so the hundreds of hours that I spent in the beginning before I quit my job, a lot of that time I spent looking at all the problems in this ecosystem. I was like, why is this thing not going to work? Why is it not going to work? Why is it not going to work? And I was looking at, proof of work, like this is obviously not going to work on a large scale. And then you look at this proof of stake thing, I'm like, but it's not as secure. But then you start really digging into it. And like a lot of the cryptography, like people have been doing proof of stake as a concept in cryptography has been around since the 90s. Like it's not a brand new concept. A lot of this cryptography, like directed acyclic graphs, dude, people were doing that work in like the 70s, right? And now you're just trying to weave it into computer science. And so like that gives you a little bit of comfort that like you're not just like trying to pull this stuff out of thin air.
Well, it's what makes it so interesting to the smartest people in the world, right? It is the true like polymath type environment where you got to have knowledge and some kind of experience or perspective from a whole bunch of different disciplines, and you pull them together. And it's not just let me pull economics, computer science, geopolitics, and like the history of money on an even basis. I actually might only pull 10% from economics and 50% from psychology and 30 whatever. And so how do you build that into a skill set that then not only helps you understand it, but then you can deploy capital against?
Yeah.
Right. And sometimes those two things actually aren't the same. And I think that's part of what draws so many smart people into this space is there's problems that need to be solved and they're not solved yet. They may never get solved or they may get solved tomorrow.
Right. And it's the puzzle of all puzzles, right? Because there are so many aspects to it. And yeah, it's why, it gives you so much to chew on, right? And if you figure it out, obviously from an economic incentive perspective, right? Like if you get it right, like you're going to get paid.
You win the game.
Yeah. You're going to get paid on that. And so, and like, not to get like cheesy, but like the societal aspect of it as well too, was super important to me because like Ikigai.
Yeah. So let's talk about what you're doing today and kind of where the name came from.
Yeah. Yeah. So Ikigai, ancient Japanese concept that means reason for being, super old, where it's like 1200-year-old word. There's books and stuff written about it. If you Google Ikigai, it's there you see this like Venn diagram, and the Venn diagram's like what you're good at, what you like to do, what you deserve to be paid for, and what the world needs. And I just came across the concept randomly like a year ago, and I really liked it. And like, to be honest with you, I had a career in hedge fund investing, right? And I liked doing it. I was pretty good at it. I made a fine living doing it, but like the world doesn't need another hedge fund manager, right? The world doesn't get another hedge fund manager. The world's gonna be just fine. And
some people would argue we could lose a couple and be okay.
And be just fine, right? But the world needs this technology. And the technology is a platform to go affect societal change for the good. And like, I'm much more of a realist than I am like, you run across a lot of like techno utopians, the type of person in this space, a lot of those dudes, right? But I'm much more of a realist. But what I saw was society starting to recoil from these monopolistic abuses of power at various different levels. And you start seeing these trends, right? It's like Brexit, Donald Trump getting into office, hyperinflation, NSA stuff, like Facebook election ads, right? Black Lives Matter, Harvey Weinstein, Cambridge Analytica. Like there's a common theme that runs across all that. And you just have to look at all the surveys of millennials. Millennials are the generation that have a deep distrust of governments, large financial institutions, large technology companies, right? Like it's like Facebook takes your data and they do shitty stuff with it. Google takes your data and like they don't keep it safe, right? And like Apple like takes your data and like makes these other products and they hook you in and they like box other people out. So it's like, it's pretty monopolistic the way they do stuff, and like stuff gets hacked all the time. Equifax, right? Like what?
I mean, look, if you are under the age of 40, you might as well just admit or give in to the idea that your data, your personal financial data and your actual personal data is floating around on the internet somewhere, and if somebody's got money, they can buy it.
Facts. You can get like 500 credit card numbers for like $5 on the internet, like on like whatever black market stuff. But you look at just millennials in general, and the same way that polls are showing you how much that distrust is, the older you are, the less you think Bitcoin makes sense, the more you think gold makes sense. The younger you are, the more you think Bitcoin makes sense, the less you think gold makes sense. So you fast forward a couple decades from now, and millennial, like we're all like, 50. And like, what do you really think is going to happen?
Yeah, I mean, look, we go and talk to these institutional investors all the time, right? And I always tell them, I say, listen, if you don't take anything else from this conversation, understand that people under the age of 35 have an amount of their net worth in this asset class that would make you just absolutely disgusted,
yep.
right? I'm talking mid double digits in many cases, yep. where we're talking, 35, 40, 50, sometimes even 70, 80% of yep. their net worth, their total net worth is tied up in digital assets. Now, some of it is they put a little bit in and it exploded in value, and so it grew. But I also know a lot of people who are taking, 50, 60, 70% of their salary,
yep.
and they're still buying,
yep.
right? And they just, it's a store of value, it's a medium of exchange, it's the new stocks, the commodities.
It makes sense. It makes sense.
It just renesates.
The problems are going to get solved. The hiccups with the industry are solvable hiccups.
Absolutely.
Right?
And also it's the opportunity cost, right? So,
yep.
if you think if you're an institution, you got to hit your 6 to 8%, kind of actuary assumed rate of return in order to pay out the millions of people who are depending on you. If you're an endowment for education or you're a pension for retirements, all this stuff, you're not hitting that today in most cases, right? Well, if you can't hit 6 to 8%, where do you go?
Yeah.
Uncorrelated digital assets is one area to look. And so millennials are saying, even if I could hit 6 to 8% in the public markets, debt, real estate, all stuff, that's not interesting to me. I can take a bunch of risk. I'm young. So where do they go? They go for the 600, 700, 800% annualized returns that they just saw. And so they're going to continue to do that, yep. right? And so it's all of these forces at work that drive a huge amount of capital from a very specific demographic into digital assets. Everyone else is going to follow. They have to follow,
yeah.
right? It may take longer, but it's going to happen.
Yeah, we internally we talk about it. It's like musical chairs, and sovereigns, they have their game of musical chairs that they're playing, and like institutional investors, right? Like endowments. State pension funds, state plans, things like that. It's like a game of musical chairs, and like Bitcoin just stopped the music, right? Or Bitcoin's in the process of stopping the music, and like nobody's really sitting down yet. You hear whispers, right? Like there's some people in the Middle East buying like a lot of Bitcoin, right? You hear that, right? Like there's like, you hear whispers about stuff from a sovereign perspective. Like we know there's definitely some like large financial institutions that are definitely sniffing around and like, maybe got a little exposure here, a little exposure there. And it's like, maybe something crazy happens, like Italy gets kicked out of the EU, right? And like the European Union starts looking like it's like questionable, which is like not a.
There's a non-zero chance.
That's a totally non-zero chance over the next couple of years. Totally non-zero chance. And then all of a sudden, it's like you hear that like the Swiss sovereign wealth fund, like they're long some Bitcoin, right? So now Switzerland just sat down, right? And there's not that many chairs, right? You got 21 million Bitcoin, a couple million of them are lost. Right. And so now people
only
are like,
17 million have been mined, right?
Yeah.
Game on.
And all of a sudden it starts looking like it's what we were talking about. It's irresponsible to not be involved. And the reflexivity and the price action, when some of that stuff starts catching on, the potential, I mean, it's going to be breathtaking.
Yep.
The way that some of that stuff plays out.
Look, we actively tell these institutions, right? It's the best performing asset class for the last 5 years. If you add 1% of digital asset exposure into a global 60-40 portfolio, the returns go up by anywhere between 100 to 300 basis points, depending when it was, and the standard deviation of risk stays about the same,
yeah.
and you get a double-digit increase in Sharpe ratio.
Yep.
The second that you start looking at that, where else can you get that?
Yep.
Right? And so it's not about how high can it go. It's actually about managing risk of your overall portfolio, and if you have zero exposure to the asset class, you have to immediately get off zero.
Yep.
Right? And we literally, I mean, you can imagine talking to a 50, 60-year-old CIO who manages billions of dollars and telling them, get off zero, right? That's the message right now. And I think to your point, there's people who are starting to do it, but when it actually kind of the dam bursts,
right.
Watch out.
Right. Totally.
Right. All right. So let's talk about some of the things that are happening kind of before that happening. Right. So right now, I know that you've got some really interesting thoughts around like BitMEX and some of these markets that are already here that people are already using today. Like, what do you think is so interesting about those types of companies and markets that are being built?
Yeah. So earlier you were talking about like, how do I change my mind? I mean, part of it is you create all these processes around intaking every aspect of information that you can. about the development of this space and assessing that information and putting it into a broader kind of mosaic framework to help it make investment decisions. And a lot of that is just thinking about market structure. And year to date, the two 800-pound gorillas that have shown up from a market structure perspective year to date is BitMEX and the Asian algorithmic market maker. And
let's go BitMEX first. So explain, what is BitMEX? Why do you think it's the gorilla? One of the gorillas?
Yeah. So BitMEX is a non-licensed exchange or unregulated exchange. They trade a synthetic Bitcoin future. You fund only in Bitcoin. You can get up to 100x leverage, long or short, on Bitcoin. It's been around for a few years. Wasn't that popular, especially in 2017 when everybody was going shitcoin hunting on Cryptopia and KuCoin and Binance. But as the market's woken up year to date and realized that all that stuff's worth zero, BitMEX has become, I think they've got like 2 or 3 times more volume than like the number 2 exchange. And you can get massive leverage on it.
So I really want to talk about this leverage thing because I don't think a lot of people understand, one, what is leverage, and how do people use leverage in a positive manner, right? And then what can that do to the market on the negative side as well?
Yeah. So specifically in the context of BitMEX, like if I put 1 Bitcoin long with 100x leverage, that means I'm getting returns like I'm long 100 Bitcoin.
So you take out of your wallet or your portfolio, you take 1 Bitcoin, which is whatever, $6,000-$7,000 today, and you put it down and say, I'm going long. I think it's going to continue to go up in value is the bet, right? But you're getting credit for actually having put down 100 Bitcoins and saying these 100 are going to go up. Why does BitMEX do that?
Because humans love to gamble.
All right.
Yeah.
And so what is the economic benefit to you when you put this 100x leverage on, and what is the potential negative side effect?
Right. So if the price goes up,
if you're right,
then you're generating returns like you're long 100 Bitcoin, only putting up 1 Bitcoin worth of risk. However,
great risk return profile.
However, specifically on like the 100x example, the way the margin works is it doesn't have the way normal margin works, like in the real world. It's a function of how much money you have in your account. And as long as you have money in your account, you continue to make, like at the end of the day, there's margin calls, and you like make it up if you're losing money every day to like kind of stay even in your account.
So you can basically pay down the margin. You can keep
your
posting
losses,
more collateral.
right? And you can stay in the position forever. The way it works at BitMEX is the leverage is only specific to that individual trade. So if you have 100x leverage on, you lose 1%, you automatically get stopped out, and you lose the 1 Bitcoin that you put up. Or if you're long 25%, if you're long like 25x leverage, then you get stopped out at like 375 bips, whatever the number is, right?
And
downward.
So great deal for BitMEX.
Oh yeah,
right.
Arthur Hayes, man.
I mean, just absolute savage, right? And just printing money now.
One of the most savage guys in the space. Period.
Yep.
Complete macho man, Randy Savage. Yeah.
Look, and we talked about it before. I mean, the part that I love is not only that he's created these products and he's got them out there and people are using them, but he is out pounding the table saying we have them, right? So he's on Twitter and he's saying, look, you good traders go both ways, right? Up or down. Let's see what you got. Yeah,
and he introduced, so he started rolling out new instruments, right? So you got directional ETH exposure. You can get up to 50x leverage on Ethereum, and you get paid in Bitcoin. You don't get paid in Ethereum. If you make money on the short side, you get paid in Bitcoin. So you're shorting Ethereum, making money in Bitcoin. Same thing.
Which most of the shorts love.
Yeah, of course, right? You can now go long short on Ripple, Tron, Bitcoin Cash, EOS, Cardano, and with varying up to 20x leverage on some of them, 50x on others, and quantitatively, a listing on BitMEX has been the kiss of death year to date.
So I was just going to ask you, what do you think this is doing to the market?
Well, what it's done is it has given a venue to now have true price discovery, two-way price discovery.
Because previously you could only go long.
You could short on BitMEX, but you didn't have enough liquidity. And now there's a ton of liquidity on BitMEX right now. So you can really express it, except, which I'm glad you brought this up, it's the worst kind of liquidity.
Why?
Because it's liquidity, except there's extremely sophisticated quantitative investors, Wall Street guys, like
your old world.
Yeah, like not specifically 0.72, but like
those types of people.
Like those types of folks, right? Like the best in the business and from a quantitative perspective. You know, I don't want to name names. One of them rhymes with lump. The other one rhymes with BE raw. So these guys are doing liquidity modeling on BitMEX. And the way that works is they call the network 3 times a second. And by calling the network 3 times a second, they're pulling down very minute volume data. And then I'm not 100% sure, but I think how they do it is they can see where the price gets executed relative to the specific volume at that moment, relative to the bid ask. I think they can back into the amount of leverage that was put on for that specific trade at that specific moment, 3 times a second.
Wow.
And then they're able to then map out where the stops are. And then you can map this out, and then they see where a bunch of stops start getting stacked up on top of each other. And
foot on the gas,
right? And then it's just like a Jenga game, except these really sophisticated quants are the only ones that can see the Jenga tower. Everybody else just thinks it's like, oh, there's no blocks being pulled out yet, but they see the whole thing. And then when they see all these stops that could potentially get pushed over, then all they got to do is go and give the Jenga pile a little nudge, and then you run through all those stops. And so if you just look at the price action over the last handful of months, like, it's so obvious that like that's the market structure that's going on. Mm-hmm. And
that's when you're seeing it. If you're a retail investor, you're seeing a immediate, within seconds, 400 price jump. Right. You're basically tipping it over.
Yeah, that's right. And everybody gets stopped out. And then also BitMEX works just fine until you really need it to work, and then it doesn't work anymore because it gets shut down because there's too many people trying to trade, and then all these stops get run out, and then the really smart guys take all the retail guys' money. So that's terrible for the long-term health of the ecosystem, which is why I wanted to talk about it today, because it's really like, you know, those vines that wrap around the tree and they kill the tree if you let the vine sit there long enough. Yep. Like that's like exactly what like that type of stuff is happening right now. And so it's really to the detriment of the long-term health of the ecosystem. I'm guessing that it's untenable in the medium term, and something's going to happen. I don't know what's going to happen.
But is it more so like a regulatory type solution, or is it just that more people come into the space that are smart, and then they all kind of start commoditizing some of this, and you get some relief?
Well, the way that I think about it is, like, if the quant is the bully, and like the retail guys, like the small kid in school, like every day the small kid's like walking into school and getting punched in the gut by the bully, and he gets his lunch money stolen. After a while, like, you just stop going that way, right? And like that's exactly what's going to happen. Like, they're just going to clear out all the retail money. It's just going to be like quant on quant crime, mm-hmm. which I think it's like, oh, this is all happening in traditional asset classes. Quant on quant crime's been happening for like a decade now in traditional asset classes. And so that's a problem. And then the other thing I want to talk about is Asian algorithmic market making, which is like the other 800-pound gorilla, which is like also the vine that's wrapped around the tree that's like going to kill the tree if you let it keep going.
All right, so let's start with just what is that?
Yeah. So I don't mind, like,
let's go. Let's get the names.
Let's see here. This one rhymes with left, free, he. Yeah, there you go.
All right, so there's a couple of them.
There's about 10 big boys.
Yep.
There's about 10 big boys, and they don't sit in the United States.
Yep.
They're not United States citizens. Their businesses aren't domiciled in the United States, so they're out of the long arm of the reach, the long reach of U.S. regulators.
They've got some protections,
which means that you really can do whatever you want to, and like it's not illegal, and like we call it. Can I cuss on this?
Yeah, of course.
We call it fuckery.
All right.
Because it's not illegal. It's fuckery. And
fuckery is a combination of manipulation
it's like morally, it's stuff that you just wouldn't do, right? And like morals is a cultural thing.
Yep.
So like I'm not trying to like look. They got a different set of cultural values than me, and like, I mean, if I was a Chinese guy that like lived in China my whole life and like I could start printing money like that, like I might do it too. I don't know, but like
You could view it as actually, hey, I'm getting back at you. You guys have been messing with us for, decades.
Whatever, right? Like, yeah, but like that's what's happening. And so like, it's one of the main reasons why the Asian ICO market right now, as we sit here today, has decoupled so much from the US ICO market. US ICO market is like almost ground to a halt, right?
Yep.
You got like a small percentage of deals that you had earlier this year.
Well, it's almost like the bully, student example you gave earlier. It's like the teacher showed up in the hallway. Right. It's like, hey, knock off all the fuckery.
Yeah, exactly. No, it's a great point. That's what was happening in the US ICO market. So now you've got like Asian ICO, XYZ token. They go raise like $40 million in their ICO. They take like 10% of the tokens and they just give them to the algorithmic market maker. And not only do they give it to them, they also give them like $6 million in ETH too. And then they get a coin listed on an exchange and then they start wash trading. And they start wash trading back and forth with each other.
All right. So most people aren't going to know what wash trading is, right? Let's start from kind of the beginning of if you're one of these tokens, you did your ICO, when you get listed on an exchange, you need liquidity, right? Yep. So there's a couple of ways to get liquidity, in your token or kind of the trading volume on a daily basis. One of them is wash trading. What is that?
Yeah, so that's you have multiple accounts set up on the same exchange, and you're buying and selling to yourself from yourself.
Mm-hmm. So you own all the exchanges or all the accounts on the exchange that are doing the high volume trading for the day.
Yeah, that's right. You're just executing trades amongst yourself with multiple accounts.
Yep, and that gives the illusion
that there's volume, there's real buying and selling that's happening. And by the way, they're just driving price. Like you're literally just like manipulating price to get to a certain level. And these guys will contractually guarantee a volume and contractually guarantee a market price, like in writing. Again, it's not illegal over there. So It's like, it's fine. They get paid hella money to do this. And then even crazier than that, they'll get in like they use like WeChat over there. We use Telegram, right? Everybody's talking about it. So they're in their WeChat groups and they're listening to all the technical indicators, like the TA guys that are talking about the different indicators that are like in this particular crypto. And they listen to whatever people are talking about, and then they just start painting a specific technical indicator. So it's like, it's a bull flag. Oh, we got a bull flag coming up. We got a rising wedge, like this, that, and the other.
I mean, but it really is it's psychological warfare against retail investors to some degree.
It's terrible.
Right? Yeah.
It is the vine around the tree that will poison the tree. It is to the detriment of the health of this ecosystem as a whole. Mm-hmm. Now, the scary thing is that the exchanges are in on it. CZ's in on it, right? They're in on it because in a bear market, they got to have these guys.
They need the volume.
They got to have them. And if XYZ token gets listed and they don't have an Asian algorithmic market maker on the back end, then the token, there's a good chance it's going to crash as soon as it gets listed because the private pre-sale investors that got into 80-95% discount, they're dumping immediately. But the crazy thing is you're giving 10% of the tokens away and you're giving 10% of the raise away to catch the volume on the back end. You see how not good that is, right? And how untenable that is and not healthy for the overall long-term.
Well, and it also, it is serving the number one use case for crypto today, which is speculation.
Yeah.
Right. Yeah. I mean, that's literally what is happening here is they're taking tokens and they're creating new speculation tools or products, and people are using them, right, for speculation, but not for the adoption that actually drives long-term sustainability.
Right. And the individuals or the entities most likely to make a profit from that situation are the ones that are the most sophisticated, the ones most likely to lose money. It just the more retailish you are, the more you're guaranteed to lose money in this process, which is just not good. I am hoping, and I don't know, maybe CZ, you're going to hear this. We'll tweet it to him. Does he like you? Are you homies with CZ?
He retweets me a lot. We've never really talked to.
All right, I hope he hears this.
All right.
When we get out of this bear market, which I don't know when it's going to be, but you got to cut the fuckery, man. You have to self-regulate. You have to self-regulate, and you got to this wash trading, the price manipulation, painting TA signals. Like you can't have that. And
here's the one thing though that I think is really interesting. So the one thing that I'll say to defend some of them, right? Because I think that you're probably right in that a lot of this is going on across exchanges, right? I think that it's just what they believe, whether they're right or not, needs to happen for the volume to be there, bear market, all that kind of stuff, right? So let's just put all that in a box and set it aside for example, or for a second. The one thing though that I think encourages me that won't be the long-term strategy is all the tokenized security stuff. right? So you start to see a bunch of these guys saying, you know what, look, the utility token stuff, the speculation, it's going to keep happening. We're making a bunch of money today, but long term, regulators are going to step in different jurisdictions. They're going to draw the rules, and we're going to have to play by the rules. And so they say, oh, tokenized securities. I don't know, right? And I could be wrong on this. I don't know if they're going to be able to do a lot of that wash trading, et cetera, in the highly regulated tokenized securities world like they can do it now. Maybe they can get away with a little bit of it, but that gives me hope that there's kind of a light at the end of the tunnel.
I agree with that.
And tokenized securities will actually make this a much more kind of traditional market.
I agree with that. Yeah. And none of that stuff can happen. Like, you can't wash trade on GDAX, right? You can't wash trade on Bitfinex. And they've got all kinds of technology to catch you.
Yep.
And like, if you do just a little bit of it, they will kick you off for sure. So like Ikigai, so we have an algorithmic market making strategy that makes money off buy and sell spreads and very liquid tokens. And we also provide US regulatorily compliant algorithmic market making as a service to tokens.
Oh,
so if you want to do it like in a regulatorily compliant way, and it's just buy and sell, it's just a 24, right? We're the 7-Eleven. We're open 24 hours a day, 7 days a week. Nice piece of technology that's sitting there. And if anybody wants to come buy or come sell, we've got a piece of technology that can easily execute those types of things. And you're not manipulating price. You're not doing wash trading. You're obviously not painting any kind of like TA signals or anything like that, because you do need a liquidity provider. I mean, look at traditional asset classes.
They have.
I mean, it's an enormous business. Liquidity providers is like a multi-billion-dollar, many billion-dollar a year business. And so that's not going to go away. You just need to do it in a manner that doesn't bend over the retail investor, right?
Absolutely. No, I completely agree with that. All right, so let's switch for a second and talk about the valuation of digital assets, right? Today I think that there's probably much more information, much more kind of theory around how do we actually use data and fundamentals to value individual assets. How are you guys thinking about this? Where do you think we are in terms of the maturation of valuation methodology for digital assets?
Yes, this is a topic near and dear to my heart. Like I pretty much stopped doing anything other than valuing stuff when I was like 19 years old. Like first upper level finance class, like my junior year in college, like it's pretty much all I've done since then. Done it in a bunch of different asset classes, done it in super liquid stuff, done it in completely illiquid stuff, up and down the capital structure. And so like when I came into this space, it was incredible to me to see how early it was in thinking about like, if I buy a crypto today, am I paying a lot or a little for it? If I buy Bitcoin today, am I paying a lot or a little?
Yep.
Well, the price is $6,500. Well, that doesn't tell you if I'm paying a lot or a little for it, right? It's just a price. When I think about like back to my old career path, like if I want to buy a share of ExxonMobil today, am I paying a lot or a little for a share of ExxonMobil? Well, I've got like 30 different tools in the tool shed to help me understand whether or not.
And the way that you're coming to that conclusion, traditional markets or in the digital asset world, is what is the price and what is the value of the actual asset? And is it above or below the value of the asset, the price I'm paying?
Yeah, price is not value.
Yep.
Yeah, price is what you can buy it for today, but you need some sort of relative valuation framework to think about, is this a lot? Am I paying a lot relative to historical? Am I paying a lot relative to other assets? So you start needing to have this like, a homogenized framework to start thinking about these kinds of things. And in traditional asset classes, there's all sorts of stuff, right? I got like assets, metrics based on assets and revenues and cash flows and earnings and growth. And like, if I want to buy a share of ExxonMobil, like, I can take like my oil price assumption, plug it into my model. There's like multi-factor models where you start breaking apart a stock and like, it's like, this stock is like a function of like, it's a momentum stock or a value stock, or it has high leverage, or like, there's all kinds of different valuation metrics. And then like I stepped into this asset class and I've read like, probably 80-90% of the things that have been written about valuation in crypto, period. Like I've read the vast majority of it. Nothing has been written about crypto asset valuation that's older than like 18 months old, which is crazy, right? Because like Benjamin Graham wrote The Intelligent Investor in like 1949 or something, still one of the most like important books on equities investing, period. And when people look at PE ratios for the S&P 500, you look at them like 60, 70 years back in time, and you're telling me nobody's written anything that's older than 18 months old talking about crypto asset valuation. So I started being like, well, like how do we think about value in this asset class?
Do you think it's important to have the traditional market valuation understanding going into the asset class, or do you think that there's value in people not having that historical context?
I mean, I'm biased, but
all right. So what do you think?
I mean, these are public instruments and they trade every day.
Yep.
And I wake up every morning and I can buy or sell my entire universe every day. And not being involved in a specific name on the long or the short side is in and of itself a decision, right? That's a position to not be involved. If I'm a tech guy, like if I'm like a tech bro out of the Bay Area, it's like a developer or whatever, like I have no understanding of that framework.
What percentage of people trading crypto do you think have read The Intelligent Investor?
I don't know, man. Way less than 1%, right?
Less than 1%?
Yeah.
Wow.
Yeah.
Okay.
You know, maybe, I don't know, 1% maybe. And look, God bless those guys.
Yep.
Because they had the vision for this shit that I didn't have. Like I was like slanging long, short energy equities when these guys were like all in this stuff. So like, I really appreciate that.
Yep.
And
different skill set, different perspective.
Yeah. And same thing with the VC guys, right? Like I really appreciate that perspective as well too. But like the way VCs invest is you make 10 bets, 7 of them go to 0. The 8th one breaks even. 9th one you make 2 or 3 times your money. The 10th one you make 50 to 100 times your money. The best VC firms in the world, they do like 1.5 standard deviations better than that. Like the shitty VC firms do like 1.5 standard deviations worse than that. But like that's VC math, right? And it takes 3 to 10 years for that cycle to play out. So just imagine the skill set that you get investing in that type of world versus investing like I wake up every morning, I can buy and sell my entire universe. And like,
and you have data to analyze and you have data to drive decisions. Whereas a lot of the venture stuff, especially early stage, you're betting on people, you're using intuition, you're going after a whole different set of criteria on a yes/no decision versus the kind of daily liquidity, data-driven, liquid market.
Right. Yeah. And so that all feels comfortable to me. And so I started looking around for how to think about crypto asset valuation, and people like to use like total addressable market's an easy one, right? Like gold's like $7.75 trillion. So if Bitcoin gets half of that, it's like 775 billion. That's up like whatever, like five times from here or more from Bitcoin.
Divided by how many Bitcoin.
Yeah. Yep. So like that feels like, okay, that's like kind of helpful. And then people started realizing that network value should be a function of network activity. Mm-hmm. And like transactions per day, active wallet addresses, even things like community vibrancy metrics, which is what, it's like GitHub, GitHub commits, GitHub stars, lines of code written, net of lines deleted. People were looking at like Slack channel members for a while, Telegram members. That it's way too easy to game that. Yep. And there's noise in all this stuff, which is like a big problem with it, right? Because it's not, again, back to like our quantum mental approach and trying to take in as many different you got to use all these different tools in the tool shed. So it's like, I can't go hang my hat on like, oh, I've got a strategy. I just wake up every morning and like, if there weren't enough transactions on the Bitcoin network yesterday, I'm sure it doesn't work like that, right? Yep. But it gives you something to try and help frame the overall mosaic approach to valuation.
So here's a controversial thought for you. I'm biased because I come out of this world, but I actually think that a group of people who have the best skill set for investing and trading in the crypto asset world is people who worked on growth teams at large technology companies, because they're used to the multidisciplinary approach around statistics, psychology, user interface, community, growth, all the network effects, all this stuff. And they brought it together to drive growth of these assets. And so there was no price attached, right? So it's really hard to say, Facebook or Twitter or whatever, hey, our network value is X and here's our stock price. There's none of that going on. But I think that the jump from that basic understanding to what price should do is really easy compared to somebody who doesn't have that understanding from a ground perspective. Completely agree. Glad you brought it up because I want to unpack that, because like what your background is a boots on the ground experience of Metcalfes Law. Right, which people have taken Metcalfes and try to apply it to crypto asset valuation a lot, and there's some truth there, and there's also a lot of lies in there as well, right? By taking that one principle and trying to apply it. Yeah, well, true Metcalfes, which is the value of a telecommunications network, is directly proportional to the square of the number of users. Yep. True modified Metcalfes has never been shown to accurately describe the value of anything. But in 2013, I don't know if you've read this paper or not, in 2013,
some guys came out. I think Bob Metcalfe himself was actually involved in this. They put out a paper, either 13 or 15, where they introduced this modified Metcalfe concept called the netoid function, which is an S-curve shape, which makes total sense, right? Because you're gonna like level out, right? Because like if I've got 5 telephones in the world and you add a 6th telephone, the amount of value that went up is totally different than if I've got 1 billion telephones and I add the billion in first telephone. Totally different, right? So it's this S-curve, netoid function. So this academic paper introduced the netoid function. And then, which instead of being true Metcalfes, it introduces this virality factor concept, and then introduces like the percentage. It adjusts it for the percentage of users that have adopted relative to the total number of users that could adopt, and it introduces this S curve. And then they showed the netoid function to accurately fit the number of monthly active users on Facebook and Tencent to Facebook and Tencent's revenue growth. And that's dope. That's super dope, right? And you were obviously front lines for that, right? And so then that got super interesting in terms of thinking about crypto asset valuation, because that feels like crypto, right? Totally feels like crypto.
Part of it too is not just where are we today in terms of what percentage of people are using something compared to the amount of people who could use it, right? So kind of addressable market and actual users, but also a lot of things that don't get talked about in crypto is like what's like the K coefficient, right? And things where like, every person who starts to use Bitcoin, how many other people can they bring into the system? It's really hard to quantify that today, right? And so there's some level of virality there, right? And as much as I joke around on Twitter about like the virus is spreading, that's really where it came from.
100%.
Right? Was this idea that if I tell you about Bitcoin and I tell 3 other friends, some percentage of you are going to say, this is stupid. Some percentage are going to be like, I'm all in and I'm going to go be the next like crypto anarchist. And some group says, I want to learn more. Right. And so like, what is that growth look like as more and more people learn this? And what we find is like, it really does capture the mental energy and attention of a whole demographic of people. It can't be stopped. You cannot kill this.
Yeah. So the introduction of a crypto asset, what it does is it allows for network effect to take hold in a completely different way than you've ever experienced in any other kind of instrument or anything like that before. Because in traditional network effect, you've got, which is, simplistically, any technology that derives a significant portion of its value from network effect, it's just the more people that come to it, the more the value goes up, right? And
each additional user makes it, X percentage more valuable as a network overall.
Yeah, that's right. And it's an S curve, right? And you get to a point where you hit critical mass, where there's a certain number of users where in the network where the sort of average utility provided for to each user relative to the status quo becomes compelling, and then it takes off, right? And you hit that parabolic phase, and then it levels off right there. It looks a lot like the netoid function. And so you have the bootstrapping phase problem with everything that has network effect. And that's like, how do I get to 1 million users, 5 million users, 20 million users, where you get to that compelling utility for each user relative to the status quo? And what the crypto asset does is it allows speculators to stand at T0, look out into the future, and make a bet about what that utility may be one day if enough people come to the technology to use it. And by standing there at T0 and making a bet in the future, those speculators are able to receive financial utility today, and that financial utility provided today makes up for the bootstrapping phase, and they literally pull a technology into existence via speculation. That is super revolutionary, dude. That was one of the big reasons I quit my job. When I understood how that worked, I was like, you've never seen anything like that before, ever.
Yeah, the only analogy I can even think of, and it's completely different, is this idea of with Facebook. So I forget the exact numbers. I'm going to mess it up, but it was like, you had to get 10 friends in the first 14 days when you joined Facebook. And so when Facebook realized this, what they saw was just getting a Facebook account, you had X% chance to stay as a retained user over some period of time. If you got 3 friends in 2 days, whatever, X% plus 5 or whatever. And they eventually realized that let's call it 80% of all users, if they get 10 friends in 14 days, they're going to stay for a year or whatever it is. And so they started to drive towards that metric. And so you join Facebook, you got no friends. They just inundate you, give us all your contacts, give us your email, right? Do you know this person? Do you know that
person? Suggestions.
I mean, they just overwhelm you until you start connecting with people. The second you hit that 10 and 14 days, bam, they back off and let you enjoy Facebook because they got you. right? The data shows them that the lock-in is there, and that network is going to pull you along to be a user. I think that, kind of social networks is very, very different than the technology we're talking about on the digital asset side. There's some comparisons or analogies, but the idea of with money, right, or economic value, it's like everything that these social networks did, right, and we did for years on steroids on a global basis, right? And it's just, I think that's what's pulling so many of these great minds in. It's a whole new puzzle, it's a whole new game, it's global, and nobody has figured it out yet. And the first groups that figure it out are going to not only personally profit, but they are going to create inflection points in the technology that are going to be groundbreaking.
So that's the thing that's actually, as a guy that was searching really hard for a valuation methodology, I got super fired up about a modified Metcalfes, read everything that's ever been written about it, talked to like professors and shit like that, and started building my own frameworks around it. And I think the issue is that, and what really got me fired up is that the netoid function accurately representing monthly active user growth to revenue growth for Tencent and Facebook. That's what really, I was like, man, this could really be the answer. But the introduction of speculation, I think, may make a modified Metcalfe approach just not really work, because the speculative aspect of it introduces the reflexivity that we've seen, and that's a function of the velocity characteristics of speculators versus users. And like that's we don't have enough time to go into velocity. I'll just say it's totally a massive thing in crypto. Every once in a while I run across people that say it's not a thing. They're literally wrong. It is totally a thing, and the velocity characteristics of the speculator, I think, may get in the way of modified Metcalfes acting the way it would in a social network setting, right? Because like I'm not out there gambling with like my Facebook users, right? Like that kind of thing. And so that's unfortunate.
It's different use case. Yeah, absolutely. Yeah. So all right, so let's talk about up till today, right? So 2018, we're filming this in September of 18. Let's talk about price action from January 1st through September 18. We just saw 20,000 in Bitcoin right at the end of the year. And all of a sudden we get this huge 70, 80, 90% drawdown across digital assets. What's going on?
Yeah, so it's a number of things. And it's kind of an aggregate. It's like we're down, whatever, Bitcoin's down 70% off the high. Ethereum's down like 85% off the high. A lot of these tokens are down 90+% off their highs. How do we get there? And it's really an amalgamation of relatively, I think, kind of unrelated things that in aggregate sort of came to that. One, you had just a blow off top in late 2017. Price of Bitcoin went from 5,800 to 20K in 34 days, bro. You mean
that's not normal?
4 days, 5,800 to 20,000, right? And completely unsustainable.
I mean, probably one of the most epic price movements of the last 100 years.
No, ever in any instrument ever. Anything.
Nuts.
Ever. Yeah. And so you had to back a lot of that out. And the price action got so drastically far out in front of its skis relative to where the tech was, right? Top 100 aggregate market cap tapped out at like 830 billion, dude. 830 billion.
It's wild.
Wild. And
because what is that? That's like 1/8 the size of the gold market.
Yeah.
Right. Or something like that. Yeah. Give or take.
And the tech's not even remotely close. Well, it's not even remotely close to being ready, right? Nobody using any of this stuff for anything, right? So you had to back a lot of that out. And then you've had all these regulatory updates as well too. And the US has actually been, I would say, less heavy-handed than feared. But there's a lot of like regulatory things over, and you've got China banning all kinds of stuff. You've like India's been super heavy-handed, right?
I mean, the U.S. regulators, in my opinion, have probably been one of the best regulatory bodies across the globe dealing with this. If you told me in 2016, as all this was really starting to pick up steam, that we were going to be sitting in, mid 2018, and they weren't going to have really clamped down on anything other than the people who like egregiously violated the law around fraud,
right,
market manipulation, all that kind of stuff, I probably wouldn't have believed you. Right. And so they've allowed a lot of things to go on that were part of their learning process.
Yeah.
Right. And really seeing, hey, what do people want to do with this? How does innovation evolve? And I think that they don't get enough credit for that. But now they're getting to the point where they're saying, hey, we got to figure this stuff out. We got to get some rules out there so the uncertainty goes away. And now people can really start to build businesses in the United States, and they're not kind of just looking for the regulatory arbitrage internationally.
Right. But there's been enough sort of globally things happen from a regulatory perspective that it's been a net negative. The uncertainty, how these things are going to get treated, it's been a net negative. It's weighed on prices. Lack of institutional grade infrastructure, totally a thing, right?
Yep.
Like there's the meme in like back half of 2017 that like, 2018, like all the institutional money is going to come into space, right? It's all, they're all going to be, it's like how, like literally how.
Yep.
Fidelity going to go buy $100 billion worth of Bitcoin and like throw it on a Trezor and like keep it in a filing cabinet.
Abigail Johnson's office.
Yeah. You know what I'm saying? Like how are they literally going to do that? You don't have any of the major investment banks like can't handle custody.
Yep.
The firms that are handling custody aren't big enough to like take massive flows, right? Like, I mean, we use BitGo for custody, but like if somebody's trying to do like 100 billion in BitGo, like they can't handle that, right?
Yeah.
And
also the institutions that are building it today, I really do think that they're looking at it as kind of like a commercial bank looks at a bank account, right? So if I build custody, if I'm JP Morgan, Goldman, whoever, if I build custody and I get you to use my custody solution, now I can sell you all of my services, trading, et cetera, around that custody service.
Yep.
It is the kind of the Trojan horse to customer stickiness. Right. And so I think that not only do they need to build it for themselves because that's what they're going to trust, that's what they're going to actually use, but then also it's a huge customer acquisition benefit. Right. And so if they can build this stuff the way that they're talking about building it, it may be the saving grace, right? It may actually give them kind of a foothold into the market that allows them to really play as real players.
Yeah, I mean, we'll get there. It's, I mean, they're throwing so many people and dollars and resources at solving all this infrastructure problem. Dozens of projects trying to do it, right?
Yep.
So it'll get solved. It's just not here in 2018. So prices have been going down, and then like volatility killed the store value thesis in the near term, right? There was that meme as well too, right? People thought we were just going to rocket up to like $50,000 BTC and then just hang out there and you're going to have like voila, digital gold.
Yep.
But like anything that goes up 14x in a year and down 65% in 100 days is not a store of value yet. People are speculating that maybe one day it will become a store of value, but it's not yet. And then like in the meantime, as people are waking up to that, and like you're not going to buy a cup of coffee with Bitcoin anytime soon either, right? It just doesn't really make that much sense to do that.
Well, and time horizons matter, right? So if you're saying, hey, I need a store of value for the next year, probably not that attractive. Right? Actually not attractive at all.
Right.
If you're saying, hey, look, I want to store a high percentage of my net worth in this over the next 10, 20 years.
Yeah.
Now all of a sudden you look at it a little bit differently, or your perspective changes on, what is your belief of the future store of value properties.
Correct. Yeah. And so it's like, in the near term, BTC not really working as an SOV or an MOE. And then, so that's hurt prices year to date. And then like, here come the stablecoin parade too, right? Right. And you're like, oh, that's how we're going to buy a cup of coffee, a decentralized stablecoin. And it's not just shady Tether either, right? And it's like,
you think it's backed up 1-to-1 to dollars?
Whatever. Like the director of the FBI, like said, it was like, okay, I'm sure, I'm like, whatever happened in the past, like,
so that's my whole thing is if at this point it's not, right, absolute, going back to your word fuckery, right? I mean, if people have been speculating on this for how long and then all of a sudden somebody goes to check today and it's not backed up, it's just complete stupidity.
Yeah. And obviously with all the FUD around Tether, it's still like the eighth largest crypto by market cap, like $3.3 billion in market cap in it or something like that. And so obviously there's a really strong need for something like that. So there, all kinds of people are trying to solve that problem, and you're getting it like, it's like, what you got, like Andreessen Horowitz is like throwing down hard on it, Bain Capital Ventures throwing down hard on it, like all these exchanges throwing down hard on it. And so,
I mean, the biggest raise is probably Nader and the Basis guys, right? So they raised like 130 million or something from the Andreessen's, Bains, et cetera, of the world. And then you've got on the other end of the spectrum, you've got the Gemini kind of regulated dollar, stable coin. They didn't raise any outside capital as far as I know, right? And so it's two very different approaches. One's an algorithmic central bank. The other is we're going all in on the existing laws, regulations, Wall Street, et cetera. The scary part is, or maybe not even scary, just the interesting part is both could win. They could coexist.
Oh yeah.
Right? There's no kind of binary, one has to win, one has to lose, which makes it even more interesting.
Yeah. So we'll see how that plays out, right? But I think that's the introduction of the concept of a decentralized stablecoin, I think, has hurt BTC prices year to date. Because like if you're a Venezuelan farmer, like, you sold your life savings into BTC at like 19K, right? Well, what you really wanted was like US dollar, like you really wanted like a stable coin that's like tied to the US dollar or whatever. And so, so we'll see how that plays out, but it certainly hurt prices year to date. And then also you've had this focus on valuation and specifically token structure, and like token structure in the context of value capture. And like there was sort of a general thought in 2017 that like these ICOs, like if more people come to this technology, the price of the token is going to go up. And it's not that simple, right? And you know, the vast many. It's
also what every Ponzi scheme believes as well. Right?
many of the like 16, 17, early 18 vintage ICOs, the token structure is fundamentally flawed in its ability to accrue value over the long term.
Yep.
And people didn't realize that then because nobody was talking about valuation. And what really happened was, I think, was Chris Bernitsky wrote Crypto Assets, which was like a year ago, literally a year ago. He wrote that book.
And probably a top 5 recommended book in the space
Yeah,
already, right?
Yeah. If you're introductory, you got to read it. Yeah. And he threw out MV equals PQ. And then people got super fired up about MV equals PQ. And then like 60 days after they got really fired up, people were like, this doesn't work at all for ABC reasons, which were valid reasons.
Yep.
But what it did do was it shined a spotlight on the velocity problem. And people were like, there's this thing called velocity, all else being equal. The faster a token spins through the ecosystem, the lower the price needs to be for that token to satisfy the economic demand of the ecosystem as a whole. And it's not something you plug into a model. It's not, you don't use it like that, but you just know directionally if the mechanism design isn't such that people want to hold it or have to hold it, or you have to stake it where you can't move it for a while, or whatever reasons, if there's a tendency to move it really fast, it's going to have a hard time accruing value over the long term. And that was kind of like year to date, people have woken up to that. And so you've just seen this big drain of market cap, specifically out of, BTC dominance has been rising for 4.5 months now. You've gone from,
I think like 57% now.
Yeah, I think you've gone in a straight line from like 34% to like 58% or whatever over the last 4.5 months. The market's obviously telling you something there. And when I think about like what's a bottom in this market going to look like,
where we all right? So that was year to date. Let's go outlook, right? So are we at the bottom, and if not, where are we going?
Yeah. So I like to look at
Novogratz called the bottom. He says that he says we hit the bottom a week ago or so, or a couple of days ago. What do you think?
Novogratz is a nice guy. No comment there.
All right.
Shout out to David Namdar too. I like Namdar.
I love Namdar. He's one of the best. All right. So where are we going?
So on CoinMarketCap, I like looking at top 100 aggregate market cap minus BTC, which I call bottom 99 market cap.
Yep.
That number peaked in the first week of January at $547 billion, which is that is an outlandishly high number when you think about it.
That's like 1/14 of the gold market.
Yeah.
For by the way, 99 of those tokens, majority of the world couldn't name a single one of them.
No.
Right? Yep.
And nobody's using any of this shit for anything because it sucks, right? Yep. And there's 27 tokens that have 400 daily active wallets. Just saw that stat like a week ago. That's a wild stat, isn't it?
Yeah.
27 tokens with 400 folks that care at all about this thing. And so that number,
when moon.
Right. So that number currently is 89 billion for the bottom 99.
So it went from, we say 540 to about 89?
540 to 89. But 89 just takes you back to the first week in November.
Yep.
So shit was still super wild before then, right? Everybody remembers that, right? Like summer of 2017 was still super wild.
The barbers, the taxi drivers, they were all talking about it in first week of November.
Yeah, exactly. And so if I just go back and look at where that number was, for example, on July 17th, that number was 36 billion. In the first week of September 15th, that number was 50 billion.
Yep.
So I kind of use that number to triangulate where a bottom might be, because it's actually easier for me to think about what everything below Bitcoin should probably be worth.
I mean, you're talking about 50 to 2/3 drawdown to go from here. right?
Yeah. So I actually think there's a good chance. I'll put it this way. I think it would be healthy for the space for us to get cut in half again from here on the bottom 99.
Yep.
Like top 100 minus BTC.
And
so then you look, so then you can
Bitcoin.
So then you triangulate that number, the bottom 99, with BTC dominance. And then I've got a chart that I've been looking at for months now where that, and then that backs you into what BTC price is going to be.
What do you
and
think?
So we
won't hold it to you, but what direction? Where do you think we're going?
Again, technical analysis is like not the end all be all at all.
Yep.
This would be like the first quintuple bottom in like the history of TA. Like that's not how TA works. Like a number doesn't get tested 5 times and then like it holds. It's just like not really how it works. So you never know.
What you're talking about here is, let's call it the
5850.
Yeah, 58, 59, whatever it is, right? Basically, we're knocking at the door. We've knocked 4 times, right? And if we kind of stay at, the 6,500 number, whatever, and we go back down, is it the 5th, is it the 6th, the 7th, however many times we're going to knock at the door, eventually the door opens, we fall.
Yeah.
Right.
Yeah. And it's going to be a function of getting dragged down by that bottom 99. Mm-hmm. When Arthur Hayes, the founder of BitMEX, introduced the Ethereum perpetual swap, he had a blog post called Ethereum, the double-digit shitcoin. And Ethereum was trading at like 400 or three something.
Off a cliff to what? What did it go down to? 180?
161.
150,
161 on the bottom. And I mean, you want to talk about a dead cat bounce that we've seen over the last couple of days, like that's kind of the definition of a dead cat bounce.
It was gone from 160 to like 215, 220, right?
Yeah. And now we're sitting right now there. So like, I think we do probably go see 100.
Yeah.
So
you got 100 Ethereum.
And that puts you at 10 Bs. That puts you at 10 Bs for Ethereum. And then you start backing into like, okay, where's Ripple going to be? Ripple, like literally not a functional token, right?
Yep.
We all know that. Bitcoin Cash.
By the way, the Ripple Army loves when people come on here and talk really highly of Ripple.
Shout out to Ryan Selkis going on flourishing, dude. That was some wild stuff, man. I love 2-bit, man.
Listen, here's why I respect the hell out of that guy is because he doesn't just talk about it on a podcast. Mm-mm. He says, listen, Brad Garlinghouse, where you at? Let's just talk about it. We'll film it. Let people decide what they want to decide after that. And so, look, there's a non-zero chance he's right, non-zero chance that he's wrong. Yeah. I think he would be the first to admit that. I actually tend to think that the Ripple crew is doing what they believe to be best, right? I don't think that they're out maliciously trying to screw people over or whatever. And so, I'd love to see that conversation because I actually think that there would be points scored on both boards.
Yeah. Right. So as a I'm agnostic in my views. Yeah, I don't fall in love with any of this shit, and I don't fall in hate with any of it either.
Yep.
And I think it's really hard to be short Ripple here because I think the senior folks at Ripple realize that their token, you don't need it for XRapid.
Yep.
And now they know that the whole world knows that.
Yep.
And so at any time they could introduce new functionality on XRapid where then you need or you introduce this new concept where XRP like there's some compelling reason for it to exist in the context of XRapid, and that thing that'll be the quickest 5-bagger you've ever seen in your life, dude. Totally, right?
Well, and because what you're talking about here is there's like price action and kind of there's TA, there's some of the fundamental stuff, whatever, and then there's just these wild cards in this market where the I don't even want to call it price manipulation as much as just like the ability to evolve the code and the kind of structure around these tokens in a night and completely change the landscape. Right. Is unseen in almost any other financial market in the world.
Right.
You can't, if you're Facebook, you can't say, hey, we had, $400 billion market cap and we did, $40 billion or whatever they're doing now in revenue, and overnight, oh, by the way, now we're doing $100 billion.
Right.
That just doesn't happen.
Yeah.
And so the difference here though is, revenue isn't necessarily driving the token price. And so it could be literally how it's used. You change it overnight, bam, all of a sudden, completely different ball game, and we're going up, 5x.
Especially for a lot of these utility tokens, right, where people have realized that the initial token structure just doesn't accrue value over the long term. And so the way that at Ikigai, the way that we break up the world is you kind of think about your Web 3.0 stack, but then I think about and we consider the top 150 cryptos by market cap as our universe. Those are the tokens that we collect data on, do analysis on, watch everything.
Yep.
You have the tokens that are vying to be store of value. Bitcoin's obviously leading that. I put Bitcoin Cash in that bucket. All the privacy tokens go in that bucket. Decred goes in that bucket. And the value framework that you put those it's its own separate beast, right? Because it's like it really is like that Austrian economics type of framework, right? And it's like hard money versus soft, sound versus unsound, and that's the kind of framework you put around store of value. And then you have the platform level protocols, so like smart contract platforms, dApp platforms, payment rail platforms like Ethereum, EOS, Stellar, Cardano, Qtum, Archain, Icon. I know I forgot some other ones in there, right? But you get the point, right? And the value proposition for those, they're a function of the activity that happens on top of them, right? You don't write any Ethereum smart contracts. Ethereum ain't worth anything, right? No payments going through Stellar, like it's not worth anything. And so you think about the value proposition for those as a function of like, how have they built the specific sort of way that you talk about the scalability trilemma, right? Like how many transactions can it do? How secure is it? How decentralized is it?
Yep.
Where do they set those levers to be the best home possible for the type of activity they're trying to draw onto that network? And like the analogy that I use is like when you make your own character, like on NBA 2K, right? Like if he's like got really good hops, like he may not play defense that well, or like if he's a great passer, like he probably doesn't dunk that well.
Yeah, we're not looking for all NBA offense or all NBA defense. We're looking just for all NBA.
Right, and so you got to set the levers at a certain point to be attractive to that certain type of activity to come on top of it. So that's those valuation frameworks. Then you got utility tokens. Specifically within utility tokens, you got productive utility tokens and non-productive utility tokens. Productive utility tokens are like work tokens. And that's like Augur and Numeraire, where you can actually model those, and you can model them in the same way that I used to do like a DCF on like a company, like an equity.
Yep.
And so the valuation framework that you think about those actually kind of looks like the real world. So it's easier to get your head around how to think about what those look like. Then that leaves you with non-productive utility tokens. Those are the ones we haven't figured out yet. But what we do know, generally speaking, is that like MOE tokens, they don't accrue value over the long term. Like if you're just a Chuck E. Cheese token, like you know what I mean? Like you can't put quarters in the video game, right? You got to take your $5 bill, you put it in the machine, you get out Chuck E. Cheese tokens, put the Chuck E. Cheese tokens in the video game. But like when you're done playing Chuck E. Cheese, like you don't want to hang around with the Chuck E. Cheese tokens. You give me your quarters back, right?
Yep.
Do not accrue value over the long term. That's a big problem for many of the 16, 17, early 18 vintage ICOs.
But the problem is also this is the whole thesis around inflationary monetary supply. Right, is that actually what they're doing is they're trying to incentivize you to spend, to not hold on to the cash because it loses value every single year as inflation hits.
Yeah.
And so the deflationary model is the exact opposite, right? And this whole idea of store value, blah, blah, whatever. But on the inflationary side, what we're seeing is if we want you to spend, the price is artificially depressed because of the downward pressure. Right? Like it is
right.
It is intentionally there because that's how the structure becomes, and so it's a really bad speculative investment if you are trying to go long on the value of the token.
Yeah, and you know we can keep going as far as you can go really far down that in terms of like what do you need decentralization for in that specific instance, and like in many cases like don't tokenize, like it's not a good idea for you, and like but for utility tokens, non-productive utility tokens, we haven't figured out how to make the token structure accrue value over the long term. And so, but at some point you're going to figure it out. I mean, the ecosystem will figure it out.
Too many smart people.
Yeah. And then I think you could see a situation where if you've got a compelling piece of technology or a use case that exists today, but the token structure doesn't work and it's out there, down 95% year to date, if somebody goes and figures out the token structure in another token, you may see just this massive swath of restructuring of token structures. And then they're like, oh, look, we fixed it and it works better now. Like come use our technology. It's hard to say how all that stuff's going to play out. But
that's really scary. If you're long or short, you don't know what's coming.
Yeah.
Right?
Yeah.
I think it's really, really hard.
It's hard to make money on the short side in this space.
Absolutely. All right. So let's do a rapid fire here. What do you think is the most controversial thing you believe in crypto, right? So like something you believe to be true that you think a very high degree of other people would disagree with you
on? The bottom 99 is probably going to get cut in half from here before we bottom.
Yep. And Bitcoin, the relationship to Bitcoin there is you think it's getting dragged down 50% as well? Or
no, it's going to hang in. It's going to hang in better. Though, it's really, really hard to say. I'll just say that in that scenario, it's hard for me to imagine that 5850 holds as the low. Yeah.
Yeah, I think that's fair. I think there's a lot of people who disagree with you, right? Because here's the other part of this whole idea around like price action and where's the bottom, all the stuff that people are talking about. I've never seen a market where there was bull bear, kind of cycle that turned over, and people still remembered the bull market, and you hit the bottom. Right. Like from a psychological standpoint, if you go on Twitter right now, people literally think we're going to $20, $30, $40, $50,000 by the end of the year.
Yeah.
Right. And it's just, I can't believe that, there's no blood in the street and we're going to turn it around.
Yeah.
Right. And so like, I came out and I said this and people all freaked out, oh, you're like switching your mentality around all this. And I was like, there's just not enough pain yet.
Yeah.
Right. And when the pain gets really, really bad, people are going to walk away. They're going to say, this is over.
Right.
That's when I think, we are at least near the bottom, but we really haven't seen that yet.
Yeah. I was an energy investor for 7 years, right? Like I've seen some major league chop in markets before. And like, if what we just had was the bottom, I'm going to have to rewrite my understanding of what bottoms look like. Like, I'm just being honest, man. Yep. I'm so willing to be wrong. And I'll text you when that happens. I'll text you. I'll be like, I think I might've been wrong.
Yep.
I'll text you, and then you can tweet it out to like the millions of Pomp fanboys.
Amazing. All right. So what do you think is the most interesting or important company in crypto other than what you're working on? I love the rapid fire. It gets the pauses and answers every time.
I'm not going to name anybody specifically.
Okay.
I'm going to say anyone working on mechanism design and token structure. Anybody. Like it's like I got like some buddies in Token Foundry.
Yep.
At Consensus, and like Consensus is like it's kind of a mess, right? And everybody knows that. But like some guys in there, they're like crazy smart. Shout out Rocco. You know Rocco?
Yeah.
Rocco's the man, dude. Rocco's right. And like anybody doing that kind of work, digging deep on like where's the video game designers at, man? Where are those guys at? How are you not in this space?
Yep.
Right? Where's my Harvard PhD mechanism design guy?
Dude,
like, what's he doing right now?
This is the listen. I keep going back to this idea of so the people who worked on growth. It was the badges. It was the streaks. It was the all of the points and tokens and all this crazy stuff that people have been doing for years are now tied to a value that can be traded. It is all of that design on steroids.
100%. Oh, by the way, I'm gonna retract my most controversial thing.
Okay.
FOMO 3D, one of the best things to ever happen in crypto.
You got to explain.
Again, complete scam. Literally a Ponzi scheme. The regulatory the little drop down, like when you click through it on like the regulations, it takes you directly to the SEC's website for definition of Ponzi scheme. It's like the website's called exitscam.com.
Yeah.
2 months before I heard about FOMO 3D, we were talking internally about how we're going to figure out this token structure problem for non-productive utility tokens. And I was like, when we get it figured out, it's going to look like this gimmick, and it's going to look like this little thing. And when people see it, they're going to be like, "That's bullshit," but it's going to work. And people are going to like, "Wait, is that like that shouldn't work, but it's going to work anyways, right?" And then the next thing you know, it's going to skyrocket some token to 100 billion because it had that hook for mechanism design to like lock in that virality and to economically juice network effect in a way that accrues value over the long term. FOMO 3D, again, not supporting it, but I'm saying that concept abstracted into part of a utility token's design could very well end up being the key that unlocks the value accrual.
The people who figured out growth hacking for the centralized internet won. The people who figure out growth hacking in the decentralized world will win by magnitudes more.
Fact.
Right? It's just going to be fascinating. All right. So you've got a magic wand. You can wave it, change one regulation. What do you change?
We're not doing this with the Howey test. You're doing it with something else.
Okay. Oh, so on the security side, right? So not the accreditation, but actually on the security side.
Yep.
What do you think needs to get put in there that, what does the new one look like? What are some of the components that aren't there that maybe you think should be there? Or are we too early? We can't tell.
You're using a piece of regulation that was judicial precedent that was set.
1933?
Established. I think it was, I don't remember, but I know it was about orange groves in Florida. Like that's the law that we're going to use to govern magic internet money, about Florida orange groves. Like that just doesn't make any sense, right? So if I could pull anything back, then you'd get a new law specifically about this.
So it's not getting rid of it completely. It's just saying, look, we need something new,
Yeah.
right? So we still need a test.
Yeah.
It's just what it looks like. We need to figure it out, and probably
Yeah.
the regulators have a bunch more opinions. And
who
insight than
knows?
we do.
Maybe they're going to end up. They're trying to like, shoehorn whatever, like round hole square peg this thing into making it work. And that what's his name, Hinman, introduced the concept of like sufficient decentralization, and they're like literally going to just like try and layer that on top of a rule about Florida orange trees. Like sufficient decentralization. Okay, all right.
Listen, is the orchard decentralized or not? I don't know.
I know, man.
All right, so one non-crypto question. Look, everyone loves aliens, right? Twitter goes nuts when I talk about all this alien stuff. And I recently had the thought of, out of everything people have thought about on the alien side, do aliens have pets? Right? So are there, we always think of aliens as like this equivalent to humans, right? They're going to, have some level of intelligence. They're going to kind of look like us generally. They're going to kind of walk and talk and communicate and do all this activity. But we never think about on the animal side, right? So one, animal aliens, and then two is, do they have pets? Are they showing up with some sort of equivalent to dogs and cats, or what's going on there?
I just try and draw from like precedent transactions on this one, and it's like I look at Chewbacca, right? I'm like, that was like basically like a really, really dope pet, right?
Yeah,
I think, right?
Yeah.
Did he have like sovereign rights, Chewbacca?
I don't know about that.
I don't know. Anyways, like I'd take a Chewbacca right now. So I figured that if you're an alien, like that's probably how you're.
That's what you're rolling up with a Chewbacca. All right, I have not heard that answer yet. All right, so I'll let everyone to close it out. Ask me one question. What question you got?
Ooh, what's still? I feel like I hadn't caught up with you in a while. Like what's Morgan Creek? Like what's y'all's like? What's the next like 6 to 12 months look like for Morgan Creek?
We are running around and banging our head against the wall to get every single institution off zero. So if you think of if you're an institution, you've got no exposure to what is probably the best performing asset class over the last 5 years. There's a bunch of data that shows if you take a 60-40 global portfolio, put 1% of digital assets, you get anywhere between 150 to 300 basis point increase in returns depending on when you did it, and you get a near identical standard deviation of risk. You get a double-digit increase in Sharpe ratio, and we actually
that's specifically for BTC.
Digital assets is defined in a whole bunch of different ways. Some people have done it, which is Bitcoin. Some people have done it top 10s, top 5, et cetera. That's generally, or at least directionally, where it ends up. Our argument is that if you are let's take a pension fund, for example, you're going to have to do these future payouts. You've got a future obligation to fund, all of your pension plan recipients. Your actuary comes in and says, hey, you've got a 6, 7, 8% assumed rate of return. So in order for you to pay out in the future, you have to hit 6, 7, 8%, whatever your specific plan is. Most of them are underperforming that. And so if you look out over the next 10 years around stocks, bonds, currencies, and commodities, it's not going to get you there, right? Kind of with the traditional asset classes. And so by no means do I think you should go put 100% of your assets in digital. But what I do think that you should do is you should start to get some of the digital asset exposure, because what it shows is not only does it keep the risk profile very similar, volatility, everything is attractive there, but you start to drive a higher return, right? Mm-hmm. And so that conversation is very, very different than like buy Bitcoin because it's going to be the global reserve currency, right? It's taking the crypto ethos and argument and speaking in a language that the institutions understand. Yep. And, look, I'm new to the institutional world. And so obviously Morgan Creek's been a huge advantage in getting us in the room and having these conversations. And it helps to have, folks like Mark Yusko, who's got this long track record, to be one of the people saying this. And what I found is they're incredibly receptive. They're not as receptive to the Bitcoin's the new store of value, digital gold, kind of what I would consider more the qualitative arguments. The quantitative argument of you have to hit 7% in order to fulfill your future obligations. You're not going to do that with the current asset classes. This is a semi-uncorrelated asset. And if you put some allocation here, we will get you closer.
Yeah.
It's just a data argument, right? And so I think that we're making inroads there, and we'll announce a bunch of stuff over the next couple of weeks. But I think that for the next at least 12 months, I mean, that is the campaign. It is get off zero. I can't tell you what the right percentage is per portfolio. Maybe it's 10 basis points, 50, 200, but I don't know. You got to look at each one individually.
But then what do you put them in?
So we literally say to them, look, you got a whole bunch of different capital pools. So you've got your equity, you've got your debt, real estate, fixed income, whatever it is. We're building a bunch of products that allow them to pick and choose. So if you've got an equity bucket and you're only, you got 10% of your allocation for equity, you're only 8% deployed. That means you got 200 basis points that you can actually go and buy some equity. So let's get some percentage of that into the equity bucket. Maybe you're fully deployed on the equity side, and so you've got a debt bucket. You've got some under deployment there. Hey, let's make sure we've got a debt product. And so building different products. We actually think that on the digital asset side, people are going to build portfolios. They're not going to go, you never go 100% cash. You never go 100% into one real estate strategy, right? And so they're going to build this very multi-strategy approach or kind of portfolio construction in the digital world. Now, here's the counterintuitive piece of this, and I've thought a lot about it so take the US dollar, 1970s, and before, 100% paper notes. Right? Today, 92% of the supply is not paper notes, right? So we've already had the digitization of a currency over time. The US dollar is probably the first digital currency that majority of Americans have interacted with, right? Because it's just 92%, right? And so if you look at that, Bitcoin and other cryptocurrencies, the actual currencies are just another evolution of that. And then if you look at stocks, for example, it used to be all paper, right? Then went to electronic trading. Today, if you invest in a private company, most people are actually digitally signing for the documents. They're receiving it through Carta, eShares, AngelList, whatever. They have an electronic or a digital version of that stock certificate, right? And so the idea that you're going to have a token in your digital wallet is just another kind of evolution of that technology. So what does that mean for like capital allocators? Well, Robinhood is actually a great example of somebody who has built asset management, capital allocation in a digital world. So it's targeted at digital natives. It's got a fee structure that looks very attractive. It allows you to buy these digital or electronic public equities, and now they've added cryptocurrencies in there as well. Well, if all of a sudden tokenization of real estate becomes real, will they allow you just to hold your shares of real estate in the same wallet? Probably, right? It's just an evolution. And so, when you start having that conversation with these institutional investors, I think that they're generally like, my kid's telling me this, right? My 20 to 30-year-old son or daughter is pounding the table and saying, hey, this is real. I'm interested in this, whatever. That's a little ways away, though, from like, hey, here's $100 million. Right. And so I think that's like next 12 months, we're going to see a couple of those checks get laid down. And when they get laid down, I think the dam breaks and game on.
Musical chairs.
Yeah, for real. All right, man. It's super fun. Thank you so much for spending the time. And hopefully we'll get you on here again.
Cheers.